Hello, everybody, and welcome. Today, we're going to talk about a topic that I know is in a lot of people's mind. I always stress the importance of finding the right market to implement your strategy. Doesn't matter if you're doing rental property, wholesaling, fix and flip. I found that most of the time, the issue is that the students implement, they don't choose the right strategy. So that's the right area. So that's the first thing we're going to talk about. So if you're wondering, where should I buy my rentals? Where should I buy my rental portfolio? And our rents still going strong today. So first of all, we do have a workshop tomorrow evening, Thursday at 8 p.m. Eastern Time, where we're going to dive deep into this and a lot of more things. We're going to talk about financing. We're talking about multifamily versus single family. So make sure that you sign up for the free workshop that's going to be hosted tomorrow evening. We're also going to talk about the elephant in the room, which is inflation and what's going on in the world and how it's going to affect the rental market. But let's dive into the topic for today. So first of all, let's dive into straight ahead markets. Which markets are going to be the best moving forward? Now, this is no surprise for me. When I started investing in rentals over 30 years ago, I understood the importance of doing it, not necessarily where I lived at the time, but the market that was going to make more sense, where the housing prices are still low enough where you can buy property and make $300, $400, $500 a month or more cash flow per door. Meaning, if you have a single family, is one door, two family, two doors, and so on. So you have to find those markets. So now, historically, those markets have been anywhere between the Midwest, moving towards the northeast of the Midwest, not necessarily the northeast like the tri-state area, but the northeast of the Midwest. So let's break this down. So the Midwest, we're going to talk about anywhere from Kansas City to St. Louis to Indianapolis to Chicago, Detroit. That would make sense because the markets, the properties are still at the price point where you can make a cash flow. Plus, is an easier entry point, right? You can go in and buy this property with very little down. And also, there are older areas. That means there is a lot of redevelopment, there is a lot of grants, there is city stepping in, there are aging landlords. There is a lot of things that are happening where there is a room for movement. So the Midwest, then now let's move more a little bit more north, so past Detroit, Cleveland, Cincinnati. Then we're gonna Pittsburgh. Now Pittsburgh is one of those golden nuggets that are really kind of not really mentioned in the real estate world as far as investing, but it offers a lot of opportunities for wholesaling and rentals and burr method and fix and flip as well. So Pittsburgh is actually one of those golden nuggets that people don't think about. Okay. So those are some of the areas that we're talking. Now, as you move closer to the East Coast, it gets a little harder again, because the prices have gone up and the rents are not going to supply that cash flow. But like any of the areas I mentioned about, is worth keeping notice. Now, the next thing I want to talk about is the red flags to watch out for. So the red flags are this. First of all, overbuilding. If there is a lot of new construction going on, yes, there is a demand, but not necessarily for the rentals that are going to make sense. So there is a lot. Also, there is a trend nowadays. There used to be where they built, apartment complexes, those little condos that you can, buy, rent cheap. Well, there is a big trend now about building even subdivisions of single family homes. So, and lofts and things of the nature. So if you see a lot of the new construction where this building, there's probably not the best area where to start rentals. Now, if you're going to a bigger metropolitan area like Chicago, I don't mean the whole Chicago, right? You have to pick up the areas within the big metropolitan areas that you see a lot of overbuilding and construction, and going to different areas. So, be careful to really say, if you say Dallas, it doesn't mean all Dallas, or it doesn't mean all of Houston, right? It means certain areas that you have to stay away from because of overbuilding. Loss of population. If people are leaving faster than they are coming, that's a red flag. There are certain areas in the country. It's more, I see this more like in the West Coast, California, for example, where people are moving because of regulations and taxes and things of the nature. The income's not enough to support the housing prices. So if there are a lot of people moving out of the area, that's a big red flag. And last but not least, and this affects actually even more short-term and mid-term rental, is regulations. Is regulations where they limit how long people can rent for, and also, or they ban, let's say, short-term rentals altogether. So regulation is really important, or even restriction like if you buy this property, you cannot rent it out for at least 1 or 2 years, and that happens more in certain subdivisions. Okay, so that's what three big red flags to look for. Now, the last thing I want to talk about, and then, like I said, tomorrow evening, 8 p.m. Eastern, we have a workshop where we're going to dive into this and a lot more. So make sure that you click the link and you go see the topics that we're going to cover, and also sign up. Is free, and there's a lot of great information. And the last one is how to find high yield markets, and especially long term. I am a big advocate, right? I've always been kind of advocate for that the mid and long term rentals to me is a much better bet. They're lower maintenance. You can do this definitely virtually, lower headache. Yes, maybe the income potential is a little less than short term, but again, the word here is potential. So it doesn't mean that necessarily you're going to get the income coming in with Airbnb, right? You might have empty days, empty weeks, empty weekends. And so therefore it's a little more risky. So mid to long term for me are always being sure bet if you're looking for steady passive income. Now, the first thing that I always want to say, cash flow is king. Okay, don't buy anything in any areas unless my rule of thumb is that I have to have at least $250 net per door after mortgage, interest, taxes, insurance, maintenance, and all of that. So if you don't achieve that, then that's not a good area. Okay. Then you want to look at job and population growth. Job and population growth is where people want to stay, they move, especially if you're looking to rent, let's say long term or midterm. You want to look at midterm is more like traveling nurses, corporate, students. Those are midterm. The long term is where people tend to stay for a long time. So, you have to devise which strategy. And there's nothing wrong for you to have a lot of long term and some midterms. You don't have to necessarily do one or the other. Okay. But you want to look at what is going on with the population. Is this a lot of transient? Is this near a hospital where there might be a lot of traveling nurses? Or is this near a university where there are a lot of students coming in the area, right? So you kind of have to cater your rental to the population that is there. And so you have to be careful about that. Plus the rent to price ratio. Like I said, some of the areas you are going to get more money per door than some other ones, So a lot of times I see people that invest in those areas, but it doesn't really make sense for the overall strategy, to break even between by the time you pay all the expenses for rental income. That should never be your goal. If you're looking for appreciation, that's fine. But when you have a rental, you also want the cash flow every month. So sometime I would suggest postponing the appreciation, 10 years down the road, 15 before it makes sense to sell. But that should never be your goal when you buy a rental. Your goal should be getting cash flow. So now I want to give you some resources here where to find some of the information. Okay. So first of all, some of the website here is one is rentcafe.com. They give you reports on rent growth by city, region, and also type of units. Another one is the NAR. Realtor, that's the National Association of Realtors. They always have market data, and they get this a lot from the MLS. Redfin, also redfin.com data center. They have a lot of data, like the NAR. They base a lot on the MLS, but they also give you rent trends, migration data, and they have like a heat map of the best market. Okay. And then also to check for like oversupply and declining population or regulatory risk. One good website is city dash data.com. It dives into population trends, crime stats, income level, and housing density. So it gives you a lot of the things we talked about. And also, just doing a simple Google search about the city where you are with rental ordinances, for example, to see if there are. And then if you invest in a certain subdivision or association, make sure that you read what the restrictions are as far as renting out properties, okay, before you get into that. So as far as looking for rent to price ratios and areas that with long-term potential in high yield markets, there is a couple of resources I really like. One is the Bigger Pockets Market Insights. They put up a good study about community evaluations, market trends, and also they have some calculators on there that are very useful to use. And then Roofstock Market Research, roofstock.com, their blog, they talk about uh, different markets. They base on cap rates, rent to value ratios, population growth, and so forth. So these are kind of some of the resources that I wanted to mention to support what we just talked about. But then again, don't forget to come tomorrow evening, 8 p.m. Eastern Time. We have a special live webinar. This is not recorded, it's live. It's called Inflation Proof Real Estate Strategy, Why Rentals Are the Safest Bet Today. And I'm going to dive deep into the rental market, what's happening now and next year, and why you should position yourself to start buying some rental properties. And I know the first thing in your mind when it comes to buying rental properties, you say, okay, where do I get the money? So we're going to cover that too, okay? And we're going to go into creative strategy, how to structure deal stacks, and so forth. We're going to talk about the difference in a single family into multifamily, which way you should go. Again, that's more tailored to the market. There's not necessarily an answer that fits all there. And then also how to be conservatively investing. I want to say that as long as I've been in the business, which is 4 decades, and knock on wood, I never lost money in real estate. But the thing is, I use a certain way when I analyze deals and numbers, anywhere from rentals to fix and flip or wholesaling. So we're going to share with you tomorrow evening how to do that, so you're not going to, do something wrong. And so and then we're going to talk about why the rents are actually rising and what you can do to position yourself for that. And then obviously we're going to talk also about how our community, how we can support if you're interested in really getting into rentals. I've shared my story before, how I went from zero to $10,000 plus in passive income in about 18 months. And so I'm going to share exactly how I do it. And I didn't use very little to no bank financing. Most of it was structured creatively. And where there is a will, there is a way, I always say. And that was definitely my will at the time. I had no money, but no problem. I went ahead and did that. So all that will be shared with you tomorrow evening, 8 p.m. So make sure you sign up. It's free. And we're going to share a lot of great knowledge with you. Okay, so hopefully this was helpful. Make sure you leave a comment in the chat, and also, my team will be checking here shortly and see if you have any questions. And I will see you tomorrow. Take care.